Um, so I'm all ready, huh, guys? You let me know whenever we're ready
Yes.
to. Hello, good
Recording in
afternoon.
progress.
Hello, good afternoon, good evening, everyone. Thank you so much again for taking the time to join us today on this webinar. We've been doing these webinars as a conscious effort to reach out, connect with our investors, and talk to them about new ideas and opportunities that we are seeing, and sharing the same with you. So in continuation with that, it's my pleasure today to talk about a really interesting and exciting new direction that investment is taking in terms of the way it uses data, and a new fund that we are launching on the back of that, which is the Access Quant Fund. I will spend more time about the product, but before I do that, let me first take a couple of minutes to set the context in terms of the data or the explosion of data that we are seeing all around us. It's often said by people that data is the new oil. In the old days, a commodity was the source of wealth because those nations or those companies that had rich sources of commodity like oil or coal could mine them and sell them in the market and had seemingly sort of endless profits that they could make out of it. In today's day and age, that role is often played by data, and it is companies that have access to a lot of data and who use data in a smart way that are able to really offer cutting edge products, services, etc., to their consumers. We've seen this in across number of sectors, whether it is in terms of consumer oriented sectors, even wholesale sectors, technology oriented, financials, host of areas where decision making using data is transforming how these sectors operate and how they service their clients and customers. This entire paradigm has slowly also reached now the investment world, the equity world, and what we are seeing is finally a massive explosion in the depth and breadth of data that companies release, which investors or fund managers have access to, and they can use to create investment strategies around. And that's where we have the Access Quant Fund, which is essentially a fund that will tap into the power of this data, which is available all around us in the form of the fundamentals of companies that are listed, and use that to create a portfolio that can offer investors a great long-term experience in terms of risk-adjusted experience in the market. So with that context or background, let's get into the product presentation itself, and I will start off with a very basic observation, which is that for every equity investor, it doesn't really matter what process they are following at the back end, but ultimately objectives can be summarized in a very simply in these three boxes. The first box, it's about identifying good companies to invest in. Very simple. The identification process itself can happen using different ways, using data, quantitative or qualitative assessment, research, whatever else. So identify good companies. Point number two is to buy them at a good price, what is considered a fair price or a reasonable price. And if you do that, and then sit back and invest for the long term, and if you do that, then you are creating the recipe for long-term wealth creation that is possible from investing in equity markets over the long term. So this, I'll be quite simply put, but essentially is quite a powerful context for any equity investor to keep in mind when they are looking at investment processes, then they are looking at different products and is taking a decision of where to invest. Because ultimately, what it will all boil down to is any product that you invest into, how are they achieving these three big objectives, which is identifying good companies, buying at the right price, and staying invested for the long term. The impact of this process can be seen through what has happened in the markets over the last so many years. In this case here, we have, it's a slightly complex chart, but I'll just explain it in a simple way that this is essentially the returns given by the large cap space, split between the good performers, the top 25 performers, and the bottom quartile performers. So the large cap index, as you all may know, is basically large cap in India and now are the top 100 companies. And the BSE 100 index on the left gives you a sense of the kind of returns they've generated in the last 10 years on a combined basis, which is about 8.5, a little over 8.6% annualized. What that means is that if you had invested 1 rupee in this basket of the top 100 companies, you would have got a 2.3x outcome at the end of the 10-year period. If you split that, however, these are obviously, as I said, 100 companies. So all 100 companies have not done in a consistent manner. In fact, there is a very wide dispersion between the really good performing companies within these 100 and the really poor performing ones. So if you take these 100 companies and you split them into four buckets of 25 each, and then we compare the top 25 companies in terms of performance and the bottom worst 25 companies in terms of performance. What you find is the middle chart is the top quartile, the best 25 companies, and there the return you can see is dramatically better than the index at 8.6. This basket has given almost a 27% CAGR annualized return, which means a rupee put in these 25 companies on a combined basis would have become almost close to 10.9 rupees at the end of the 10-year period. On the other extreme is the bottom quartile of the worst 25 companies. And if you look at that basket, in fact, over 10 years, that basket has not even been able to return back the money that has been invested. So if you had invested 1 rupee, even after 10 years, that level of that investment is still not even 1 rupee. So forget return, you've actually lost value even after 10 years. So this is a very, very important lesson to learn for all equity investors, that when you're investing in a product, it should be able to identify the good companies, because there is going to be always a very big difference between the good companies and the bad companies. Big dispersion, especially in places like India, where we have quite a big gulf in the quality of companies across the entire listed spectrum. And therefore, any process should be able to identify the good companies, buy them at the right price, and hold them for the long term. Now, what is the role that data can play in this process? And now we're coming to the crux of what we are here to talk about today. And data, what we find is that there is, as I said in the beginning of my talk, there is an explosion happening in terms of the availability and the quality of data around us within investment world we're talking about. What is happening really is that companies are reporting data and it's getting captured in a structured way. So they are getting standardization of format, standardization of reporting, etc. That is happening more and more. Point number two, there is more transparency in terms of companies disclosing more data, better disclosures, more timely disclosures. Perhaps in the past, there could have been delays between different companies. Some companies were more prompt, others less so. Some companies could disclose on a partial basis and not completely transparent to all investors. Slowly and steadily, I think that is getting, these things are getting resolved, and you now have reported in a structured way. That is very important, because any data process works on comparing and combining data from different companies. And if what you don't want to do is compare apples and oranges. The data has to be comparable, and that's where structured data is very important. Transparency and disclosure is an obvious point. And the third impact of these two is that as this has happened more and more, we now have a very good and deep data history over a period of time, which means that for a company which has been listed, which has been around for 10, 15 years, you have good data, but you also have history of data last 5, 10, 15 years in terms of different variables. How have they been performing within the company over the years? With these three combined allows you to essentially do a better analysis and assimilation of this information. So the fact that you have more structured information, more timely and more deeper and longer history put together allows you to really use this data in a smart way to analyze and compare companies and to take a view on different companies. The output here, because of this ability, is twofold. One is it makes the whole process more efficient, because you're not wasting time trying to find data, trying to analyze, compare data. A lot of that data is readily available, and you're able to quickly set up ways to compare different aspects of a company or analyze different aspects of the company. And second, equally importantly, it leads to very, very accelerated decision making, because If you can create structured way to read this data and analyze this data, every time a new set of data comes in, your templates, etc., are already ready, and you can take appropriate decisions very, very quickly. So as the world is getting more and more complex, this data explosion can become very, very handy in terms of being able to give us a way out of this complexity and a way out of this large breadth of different companies out there, different sectors out there, and being able to process them in a quick way, in a systematic way, and lead to some simple usable observations which we can implement into a portfolio. As a result, we believe that the use of quantitative data can really complement the traditional fund management process. What we mean by traditional process is the process that uses an investment team combined consisting of fund managers and analysts to go out and carry out qualitative research, look at data, use a composite set of different parameters to arrive at a decision on what to do at an individual stock. That is a traditional process, and a quantitative data process is basically relying a lot more on the breadth of data and using all the different data points to get that understanding and ability to take a decision. And we believe that this quantitative data-based approach can become a very good complementary and alternate way of getting alpha from the market over a long term. And that's really the exciting potential that we are looking at. And that's where our fund, the new fund, is going to try work in this market. To summarize the context and the power of this data process in terms of its framework, we can think of it as a bit of a roots and trees situation. Then if you get the roots, get the required inputs, which are these 5 boxes, which we can cover one by one. And that leads to a healthy tree in the form of, and provides the fruits in the form of the 3 boxes that you see on top. So what are the inputs that the roots need? It needs data in a structured format. It needs standardized rules that basically, because raw data is just that, it's just plain data. How do you make sense of it? That's where you need rules. The rules will tell you that if the number is X, then what does that mean? Or if the number is Y, or if it is changing from X to Y, what does that mean? And what should be the way to use that data? So that's where the rules come into picture. Systematic decision making, which means that the rules are consistent across different data points. It's that when a variable changes from X to Y for stock A, the decision making or the use will be the same as it changing from X to Y for stock B. It is not, there is no subjectivity or a different way of implementing the same change or rules. The fourth is risk management, capturing this data, using the data not just for identifying good stocks in terms of potential for alpha, but also using this data to identify the risks in each stocks and capturing that in the process. And finally, running this in a disciplined way, because ultimately it's not just a one-time exercise. Data is dynamic, it keeps changing, and you need to be able to keep applying these learnings on an ongoing basis and not just as a one-time exercise. If you do that well over these 4-5 boxes, the output that you get in the form of the fruits is a very robust investment process, which can essentially perform across the market cycle, across a longer term, and deliver on a risk-adjusted basis and not just on a unidimensional manner. And that's really the power of the quant process or the data-based process which is out there. With this context, let's talk about the offering that we have, which is the Access Quant Fund. Essentially, it's an open-ended equity fund that will invest and use this data as an input and as a model that runs using this data as an input to create a portfolio of equity stocks, which will be diversified in nature and which will be multi-cap in nature. So essentially, it's an equity product. It's a very similar equity product to when you see it in terms of the actual portfolio. it will look and feel like any other traditional portfolio, but the difference will be in the back end, where the method of constructing or method of identifying this portfolio stocks will be very simple, very different, because it will be using data in a systematic manner to identify these stocks. When we talk about the way to identify these stocks and the use of data, one thing which we should be very sort of cognizant of or aware of is that the type of data that we are identifying is very fundamental oriented data about companies. So these are companies, financial information, whether it's earnings, balance sheet information, information around valuation of the company, the growth prospects of the company, how do they work. So essentially, what we are talking about is a very fundamental based approach. We are not talking about using data, which there are some misconceptions about data processes that they are talking about uh, trading based on news flow or trading based on technicals, etc. That is not what we are trying to do here. It is essentially the data that we are talking about is the fundamental data for the companies, which is financial data for these companies that we are looking at. So what the quant fund will do is it will look at the fundamental data of these companies to identify which are the most attractive companies to consider investing in. And then it will combine that list of attractive companies to account risk factors, concentration limits, and such like, to come up with the actual portfolio into which approach. And I will reiterate the both those aspects of that. Take use of fundamental data for every stock and use that to identify the best stocks. And you then apply certain rules which take into account other parameters like risk, limits, etc., to use the most attractive stocks and use and combine them to what should be the weights in the portfolio. Let's understand both of these parts of the process in a little bit more detail. First, coming to the fundamental approach, and here what we have identified as the three cornerstones of that approach is essentially what we call the QGAR approach. And we have three, like I said, cornerstones of that QGAR approach. Essentially, QGAR stands for identifying a portfolio of quality stocks with good growth potential and buying them at a reasonable price. So essentially, if you look at that extension, essentially, we're talking about the three parameters, which is quality. Three are all reasonably well-known factors in equity market investing, but even then, I think it helps these pillars for. Let's start with quality. When you look at quality, what it really reflects is the riskiness or the stability or the how robust the business model of the company is. What that essentially means is that is the company having stable earnings stream? Is there a lot of volatility in its earnings? Is the balance sheet very robust? Is there a lot of debt on the balance sheet, which can create a lot of uncertainty? So essentially, identifying variables, etc., which will highlight the strength of the company as a business and the stability of the company as a business, and on the contra side, which could bring down or whatever, which highlight the risk on the negative side of the business. That's on the quality. Obviously, the companies that have the strongest businesses, more stable, low risk, have the highest quality variable in that sense. The second parameter is what is called growth. Again, reasonably well understood, but essentially what it captures is the kind of change in the business scale of the company over a period of time and the rate of that change. So the scale can be measured in revenue terms. It can be measured in earnings terms. And the change in that, which is the rate of change, is essentially the growth in the company's business, whether it is in the form of the top line or bottom line, is essentially talking about how the company is evolving or growing as a business over time. And the third variable is valuation. Essentially, it's the price that we pay as a function of the fundamentals of the company, whether it is on the earnings, book value, any of the other parameters. So valuation, again, reasonably well understood, but there are different ways of doing that. So what we do really is identify companies on these three parameters. And what we want to do is we want to make sure that we find companies that are doing reasonably well across all three. So if you think of these three parameters as three interlocking circles, essentially what you want to look for is the point in the center, the triangle, which is basically at the intersection of the three circles, which essentially means companies that offer a reasonably good outcome on across all the three parameters. What are we doing essentially by doing this is we are not trying to identify stocks which are just very good only on one parameter, but looking at different parameters that work in the market over a period of time. And these three are the most powerful such parameters. And making sure that we identify stocks which are reasonably placed across all three. And if we do that, then in the triangle that you end up with, we believe can be an all seasons portfolio, essentially capturing the best of the main style. So that's really what we get when we follow this approach. Let's understand through a very quick example. What we will do using the data is come up with scores for each of the three parameters, quality, growth, and valuation. And we combine them to come up with a composite score. So in this example, as an illustration, we've highlighted 6 stocks, A to F in different sectors, and what their indicative scores are for each of these. And like I said already, the scores essentially say the attractiveness. So the higher the score, the more attractive from a potential alpha perspective that stock is. So what you find is that, company like stock E, which has very high score on quality, but is very weak to poor in growth and valuation. As a result, on a combined basis, comes out looking poor. Whereas a company like stock A, which has reasonably strong scores across the three, even though it's not the best in any of these three, but it has reasonably strong across these three, comes out on top in terms of its attractiveness. So that's essentially what we're trying to do, is use the power of data to identify the most attractive stocks that should be considered for the portfolio. Once you have done that, then comes the other part of the exercise, which is to apply certain rules, analyze certain risks of these stocks, and use those combination of these rules and risks to identify how much each stocks, and we've identified, remember in the previous page, the most attractive stocks that should be considered. And once you apply these constraints, what you get is what should be the weights in the portfolio of these attractive stocks. Again, trying to analyze this, understand this using an example, what you see is the stock B and stock C, which are both financial stocks in the previous example. Continuing with them, their score from an attractiveness potential alpha perspective, stock B is at 4.94, stock C is at 3.85. So on the face of it, stock B looks more attractive to stock C. But if you combine the risk parameter and you look at it on a risk adjusted basis, suddenly the situation flips around, because what it turns out is that stock B is marginally more attractive from an alpha perspective, but is far riskier than C. And therefore, when you adjust for that risk, the portfolio will come out is that it makes sense to have a higher allocation to stock C compared to stock B on a risk adjusted basis. So to summarize the process of Axis Quant Fund, what we're trying to do inherently is something which is very straightforward, and which in a very simply put, or in a very broad way, is trying to replicate how typical active management is done using a traditional approach as well. What you do is you start with all the listed stocks out there, and you look at certain elimination criteria, which are stocks which don't have enough data, stocks which are impacted because of certain issues, etc. And then you come up with a set of stocks where you have enough data to be able to analyze and take a view on. Once you have that shorter list of say about 200 to 50 stocks, you carry out the step which is scoring and ranking, which as discussed, identify the most attractive stocks in the form of their composite scores, and you then by ranking them and identifying the ones that score the best, and then select from those just scoring the best, identify the ones which need to be invested into using risk-based variables as well. What we get as an output when we do this is a portfolio of about 50 to 60 stocks, and essentially a well diversified portfolio which has a good combination of large and mid caps in it. Uh, One important thing is that the work of the fund manager does not end at the creation of this portfolio. Rather, this is an ongoing cycle because the markets are dynamic, data is dynamic. What could be the situation today can dramatically change tomorrow because of certain events. Simplest example is if you look at last year, how things changed so dramatically from February 2020 to March, April 2020 because of the onset of COVID. It could also be a certain event, which was a macro event, because of which a number of sectors got affected. And essentially, therefore, it's not just enough to use this exercise one time and create a portfolio. You also have to be able to monitor this on an ongoing basis to identify which any changes that need to be made or any updates in the data that needs to be done. With that, we come to an end of the the context of the quant fund. We have been testing this for a period of time, and it is our belief that if we execute this well, this can really deliver a pretty consistent experience for investors. We have looked at historical data over a period of time and tried to identify how this would have done over the years. And to do this, what we did was we came up with a 3-year rolling return over the history. And what we found was that this kind of an approach, which is defined as the model, was able to deliver in a very robust way compared to the benchmark, which is BSE 200, on a 3-year rolling basis. And that gives us a little more confidence that the process that we have here really has the potential to deliver for investors for the long term. More importantly, what we've seen is that one of the advantages of a risk-adjusted process is that it is able to handle sharp drawdowns in the market better. For example, if you look at last year, when the big sell-off happened in March, April of 2020, a model like this fell less than what the market did. And as a result, when the markets turned around, this model's outcome was able to get back to its previous highs almost few months before what the main market did. So to summarize, why should somebody invest in the Access Quant Fund? The most important reason is that the strategy will appeal to investors, those investors who are investing into equities using traditional approaches and are looking for a new idea or a new allocation which can diversify their portfolio, because this is using a very, very different approach and really provides very genuine sort of diversification. It's a unique proposition using data to its advantage and creating something that is really powerful over a long period of time. In terms of its portfolio, it aims to create a diversified portfolio that is across sectors, across market cap, is being a multi-cap portfolio, and which can deliver risk-adjusted performance across market cycles. With that, we've come to the end of this presentation, and we have time now to take a few questions if you have on this product or on anything else. What I will do is I will request each of you is please do type out the questions that you have in the link. And what I will do is I will just go through these questions and I will try and cover as many of them as possible in the time that we have. So if I'm looking at the questions, Uh, one question which comes is on the situation which is because of the market, because the market being at as we all know, it's done really well in terms of the rebound from the sell-off last year, and it is obviously close to or at very near its all-time highs. So there are some questions around, given the market environment, how should people look at allocating this? And I think the answer there is very simple that ultimately, as we all know, uh, equity is a growth story. It's a growth oriented story. And what that means is that it looks to capture growth in the market, and companies give growth. Over time, their size goes up, over time, their value goes up, and over time the market captures that growth, and as a result the price of that stock goes up if the company has been growing. So what you find is that it is not unusual for market to reach a new highs over time, because markets ultimately are capturing growth over a period of time, and as the growth is keeps happening, markets do reflect that. So even if you see previous cycles, markets go through ups and downs, but even when you look at historical times, whenever markets have reached a new high in the past, there was in the near term, investors thought that they had lost out when there was correction, but if they remained invested for the long term, they still made reasonable returns even from the previous highs. So difficult to time the market. We should not worry too much about near term market movements, whether it will go up or down. Uh, the best approach that we can take as investors is twofold. One is to invest for a reasonable horizon, at least 3 to 5 years, and that negates the near term market uncertainty to a good extent. And the second thing that we can do is to make regular investments through SIPs or any other tools, because what that does is also allows you to take advantage of any volatility which happens. Because equity markets not naturally are volatile, they go through their ups and downs, and that's where regular investing can really help balance out any of those things if it happens. There's one question on how this fund is different from the the traditional funds that Axis itself has, other equity funds, or typical equity funds in the market. As I said already, the important difference is in the way the portfolio gets constructed at the back end. If you see the portfolio, it's a diversified multi-cap kind of a portfolio. So it just by looking at the portfolio, it may not look like we are doing something which is very different. But at the back end is where the difference lies, which is in terms of how these stocks have been identified and how the weights has been calculated. And that is the reliance of this process on data and use of depth of data and breadth of data to take systematic decisions of which stocks to look at. There's a question on how this model has been put together in the form that how are the rules, how have the rules been defined, or what has been the way in which we have tried to make sure that the model can deliver the expectations that we have set for it. And the answer is that yes, we have spent a lot of time putting together the model. We do two, three things. One is we've got a team of people who look at data and analyze data and work on models, and they've got a history of working on them, and they have put together this model. Secondly, we have been testing this model at our end for a long time before we have launched the fund to monitor and see how the data is being used up. And third is that this process does not stop just because the fund has been launched, and we will ongoing basis keep monitoring the model to see if we can make any, if there is a need to make any changes, and we can make so. So idea is really to do a very good amount of background work and homework before coming to the market, because we recognize that this is a new direction we are taking. It's a great, very exciting proposition, but yes, it is something that people in the market have not seen in a big way before. And that's where we've done the hard work to make sure that we understand this at our end completely before we offer it to you. We are very, very confident that the process that we've put together and which we've been tracking for the last couple of years to get ourselves comfortable has every ability to deliver on the mandate of risk-adjusted return over a cycle. There is a question on why investors should look at this fund, why investors should consider allocating to this fund, and also how does this fund compare again, as I said, or with the other funds. So I think the most the way I can explain this is like I said a little earlier, that different funds try to deliver alpha. It's not that one fund, there is any one fund which is the best fund out there. Different funds have their own styles, and if they can all do their work and deliver alpha in their own style, then investor really benefits, because as investors we know that we want to not have all our eggs in just one basket in the form of just one fund or one strategy. Prudent or risk management directs that we should spread our money into a few different strategies. Each of them are good strategies and each of them are different from each other, so that for our long-term portfolio, risk of any one strategy affecting the entire portfolio, our portfolio, is minimized. If that is what we are trying to do, then we should really welcome new ways of running the equity portfolio and managing the money, which is complementary or separate from the way the existing process works, whichever is the fund manager. It's not just about Axis, any other fund manager also in the market. The traditional process works in a particular way, and this Quant process provides a very good complementary ability to that. And that's where I think investors should use this as a part of their equity allocation to complement allocation to the regular funds, as well as a top up to this kind of a strategy. We are not at all suggesting that all equity money should henceforth get rerouted to the Quant product because it's so attractive. Yes, while it is attractive, ultimately, like I said, it's about prudence, about risk management, that we have to balance it out by allocating. We cannot have all our eggs in one basket, and that's where we have to balance it out by allocating to different strategies. And Quant fund can be a very exciting part of that allocation for investors. There's a question on expense ratio. The fund is essentially an actively managed equity fund that looks to create and generate sustainable alpha over a cycle. And therefore, it is from an expense ratio perspective, the expense ratio will be very similar to other such actively managed products, which are in the multi-cap or flexi-cap style. There's a question on whether this is a flexi-cap style fund. The idea here is, again, what we find in the category flexi-cap are funds which allocate to large, mid, and small and are run using more traditional methods. In this case, as the name suggests, Axis Quant Fund, and if you see the categorization, it's a equity scheme following a quantitative model. So basically, while the portfolio mix may look similar at a top level in terms of large cap, mid cap mix, there are very, very substantial differences in the way the portfolio itself must have been arrived at. And that's where, while this is also a multi-cap offering, flexi-cap funds also run on a multi-cap basis, this still ends up looking quite different from those kind of funds. So there's a pretty interesting question that, that analysis of data can give us a great idea about companies, but how do we solve for, unprecedented events, etc., and how can a database processes handle these kind of things? So I think one thing which I will, highlight as a part of my response to this question is that when we talk about data, we are not just limiting ourselves to purely historical data. Some of the data that we are tracking is also data about how the companies are likely to do over going forward in terms of uh, estimates about companies' growth, etc., going forward. And that's where any event can flow through. If the event that we talk about is an event like, for example, the COVID onset of last year, clearly it's a massively negative event from a growth perspective. And that to that extent, the data that the model is using to estimate, future growth, that will start get reflecting some of this. It may not be instantaneous. It may not be that in just one day all the impact will come, but slowly and steadily, as just going by the same, continuing with the same example of last year's COVID onset, and slowly and steadily the lockdown and some of these aspects came out. The impact on earnings and the impact on growth will start playing out at a stock specific level, and that is what will come through to the portfolio also. So yes, uh, we completely appreciate that it can be a little bit of a dynamic environment, and suddenly things can happen in a very different direction, or it can surprise everyone. But that is where having a database process really helps, and it can help take quick decisions and transparent and sustainable decisions based on incoming data and seeing how things are changing. And that's one of the powers of a data-based process, which is that it can take very, very quick and systematic decisions because the rules are already there in the model. And if there are any changes to the data, the model is able to immediately react to those changes using the rules that have been fed into it. There's again a very relevant question on how will the data management be carried out? Because as we may have, many of you may have heard of this term called garbage in, garbage out, which means that if the data quality is poor, any assessment or outcome from that data will also be poor. So how do we make sure in terms of the quality of the data or the accuracy of the data? And that's one of the important points I was making. It's a very important question. And one of the important points I was making right at the start of my talk, which is that uh, the confidence to launch this strategy really comes in when you start seeing the quality and robustness of the data being presented. And it's not just enough that only 10, 20, 30 companies do it. It has to be done by literally hundreds and hundreds of companies so that the fund can really analyze all the different companies and identify really the best opportunities. So, but back to your question, how do you how do you assess the quality of the data? So one is that definitely overall quality of the data is getting better and better because there are regulatory requirements, etc., in terms of the structures, the formats, the timeliness of the data that has to be presented. But also what we do is we have some very robust data sources and databases which give us this data. And the second thing that we do is we don't blindly just use that data. We run some tests which are sort of like sanity checks and sort of like error checks in the data that we have developed over a period of time. When it comes to using ratios, etc., we calculate those things on our own. And so essentially what we have done is over time, figured out ways and means to check and double check the data to establish the robustness of it. And there are ways and means through which therefore we are able to create flags if we think that there are certain inaccuracies and are able to go back and rectify that. So that is also something that with processing power, with computing power, it is now possible to run queries which can be used to establish inconsistencies in the data as well. There is again an interesting question saying that what is the why we believe that this fund, the use of data is such a unique thing, because ultimately every fund manager will use data. It's not that a regular fund manager is also not using data. And to be fair, everyone has to use data because there is no real process out there which can ignore data and take decisions. Regular fund managers are also, the importance of data is going up. But having said that, the regular active managers are using that data, but not uh, looking at that data alone while making decisions. They combine the data with a lot of their own assessment of what the company is likely to go through by interacting with the management, taking a strategic view on how the company's business potential may play out over the next few years, the capability of the management and the promoter team of the company. So those sort of things are, qualitative or judgmental parts of what the regular active managers do. And they combine that, of course, with a basic understanding or a reasonable understanding of the data, fundamental data of the company. Where this process is completely differentiated is that unlike those type of processes, here there is no subjective, there is no qualitative aspect when it comes to what to replace that. What the process here has done is increase the breadth of the data. You capture lots of different data points so that you can compare, contrast, and get a very comprehensive view on the company. And you use that data point to come up with the decisions in terms of what portfolio to invest in. So yes, to a certain extent, all processes, all funds use data, but that doesn't make all the funds similar. The way the data gets used also needs to be kept into account. And that's where Access Quant Fund, the way we look at data in this fund is very unique and different from all the other active managed products out there's a question on what type of companies that we are looking to, invest for in this product in the form of, what we'll find into the portfolio. And as I said earlier, also essentially from a fundamental perspective, we want companies that score well across these three attributes: quality, growth, and valuation. And essentially, what we're really looking for is on the between these three attributes put together, those companies that do the best, those are the most attractive companies that we want to have in the portfolio. What is the advantage of doing that? As I said earlier, find these companies, we believe that these kind of companies are essentially all seasons companies, which what that means is it's not about what they will do in the next 3 months if market is going up, or in the next 6 months, or if market is going down. These companies can deliver on a consistent basis across the entire cycle if they play out the way the model expects them to. This question on what is a multi-cap fund mean? Now, multi-cap fund is, of course, a specific category within SEBI list of different mutual funds. But any strategy can be called multi-cap if it combines allocation to large caps and mid caps in some form or shape. And if you look at this product, the Quant Fund, even in this case, what we will be doing is we will be combining maybe a 60 to 70% allocation to large caps and the balance allocations to mid caps. So because of that reason, we use the word multi-cap in this context. This is not a fund that belongs to the multi-cap category. It is a dedicated product in the form of, a quantitative model-based product. But the portfolio mix is not just limited to only one large cap segment or a mid cap segment, but it is combining across these two segments, large and mid both. There's again a reiteration and on, if this process is so good, then why not all existing funds also use this to that extent? And I again say this: see, ultimately, equity investing is not 100% science in the sense that it is about taking a calculated assessment of what may play out in the future. But we all know the future is inherently uncertain. Best of whatever we may expect and play out, uh, the reality could be completely different. And again, the best example for this is last year's COVID circumstance. whatever analysis, whatever we would have thought about in February 2020, in reality, how things played out in March, April was completely beyond whatever anybody could assess. And that is where, because there is no single way to maximize, what managers and investors normally like to do is identify a number of different approaches, each of them good in their own right, each of them having their own USP of how they are managing money and what they're trying to do, which can give them that potential for outperformance. And as investors, once you have a few such processes, from the investor's perspective, allocating to a few such processes really helps from an overall portfolio perspective because it de-risks the portfolio. Like I said, it doesn't put all the eggs in one basket, but spreads them around so that even if a particular strategy doesn't work out, doesn't perform, is not able to perform because of the spreading out of the allocation, it doesn't affect the investor as badly. There's a reasonably long question on, if we are losing fundamental factors and these data points come out with a significant lag, then how are we going to tackle this lag, or will it not lead to a very delayed decision making? Uh, so the answer is that, of course, there are different, when we say fundamental variables, there are different fundamental variables which come at different frequency. And what we have tried to do is balance out variables which come maybe very infrequently, maybe once a year. Other variables come on a quarterly basis. There are some variables which come out on a daily basis. So what you're trying to do is you're trying to make a model which is combining different variables, knowing that each variable will have its own frequency. And secondly is trying to allocate with a long-term horizon in mind. It's not trying to solve for how the stock price may do tomorrow, or these are the stocks that will go up or not go up tomorrow or the next 2 days. Is trying to identify stocks with a longer term mindset with the next 3 to 5 years. And that's where this combination provides the fund with the portfolio that can work with the long term, and while still being dynamic enough to make sure that any changes in the daily environment come through into the portfolio's thought process. There is also a related question on if it is a purely fundamental based model, are we going to react to any news flow or any market data at all? The short answer is that no, we will not react to news or rumors or news flow in the market. Ultimately, if those news items are right, etc., they will flow through in the data of the company in some form or shape. And therefore, and remember, we have found ways to look at not just historical data, but future data as well. And in terms of estimates and stuff like that. And therefore, somewhere or the other, if there are any substantial situational changes that any company is facing, then it should flow through in the data. Or if it is not flowing through into data, then maybe that change impact is not material. But otherwise, if it is material, then it should flow through into data. And if it flows through into data, that gets captured by the model and is used to take the right decisions or the most appropriate decisions. There's one question which says that I already have a large, an equity portfolio. So if I'm interested in this product, then does that mean that they need to redeem from one of the existing funds to put into this portfolio? I would say there is no real common answer for these type of questions on allocation. The best thing we would suggest is please reach out to us on a one-on-one basis, and we can look at your portfolio and understand what works best. Unfortunately, you cannot give a consistent without looking at the data advice on what is the best way. But for many investors, one thing I will suggest is that if we are having regular cash flows, regular income, anyway, we will have money that will be flowing into our savings, which we should hopefully look to allocate to equity over a period of time. Part of that at least. So if we are anyway going to keep allocating to equity over a period of time, then definitely what we can do is tailor our allocations based on opportunities. And if you're getting fresh allocations and you like this as a new opportunity, that provides a great way to capture the opportunity as well. There's a question on how active the management will be, because the data can be, of course, quite dynamic. And therefore, does that mean that the fund's portfolio will also keep changing? The answer is not really, because while the data can be dynamic, there has to be a materiality check to the data. As I also said in one of the earlier questions, every data may not make a material change to the trajectory of the company. It could make some minor changes, but we don't have to make adjustments based on that. Only if something is making a material change to the trajectory of the scheme should it get acknowledged and should lead to some kind of an action in terms of the portfolio. So because of this materiality check that we have done, what we're able to achieve is that we don't have to unnecessarily trade and on noise or create too much trading costs for the investors. But at the same time, if there are genuine changes to the environment which are going to affect the company either positively or negatively, we are taking them into account and making adjustment to the portfolio. So we have tried to keep that fine balance while deciding, how to run this portfolio. Just conscious of time, because I believe because we've got quite literally thousands and thousands of questions, and but it's really great to see so many people reach out. But unfortunately, because of time constraints, we'll probably be able to take maybe the next last one or two questions. But do reach out to us, if we've not been able to answer your question. Um, there's a question on how the performance of quant funds in general has been. And the answer is that while in India, this is a very, very new field, there are a few other fund houses that have launched quant funds, but a lot of them have been in the last year or two. So the performance track record is still building up. But we do have references of the global environment where quant funds have been around for a long time and they have been able to deliver and make a very strong outcome for their investors. So if we can execute well, if we can use the data explosion to our advantage, then we believe that this can also become a very, very interesting direction for the industry to take. I started off by saying that this will become a really big theme for the industry going forward. And I would like to believe that if the quant funds can execute, they can really deliver on that promise. One last question is on global stocks and whether the fund will invest only in the Indian stocks market or in global stocks. And the answer is it will not invest in global stocks, but limit itself only to the Indian stock market. With that, like I said, unfortunately, we've run out of time for today's webinar. Thank you once again, everyone, for joining. It has been a really exciting time for us at Axis Mutual Fund to be able to bring new ideas, new thought processes to all of you. And unfortunately, we've not been able to cover all the queries that we have, but I will encourage you to reach out to us on an offline one-on-one basis, and we will try to answer as many of your queries as possible. With that, do take care, stay safe, and look forward to your participation in our opportunities. Thanks a lot, everyone. Goodbye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.